I'm Roger Montgomery, and welcome to this week's Video Insight. You've probably been relieved seeing the market rally over the last few days. The S&P 500, for example, has made a low on June 17 and has since bounced almost 8%, dragging markets globally up with it, including Australia. I was personally feeling quite pleased with myself because I'd recently added to investments in the Poland Global Small and Mid-Sized Company Fund. But of course, investing is a long game. We're in it for years, not minutes. Nevertheless, one of the biggest objections to investing during a crisis, which history has shown to be the best time, is the possibility that the market could fall further. And of course, it could. Equities have rallied off the lows recently, thanks to a lower oil price and a retreat in bond yields amid fears of a recession. Recession concerns are now dominating the narrative, and even the head of the US Federal Reserve, Jerome Powell, has admitted the risk. Meanwhile, Google searches for recession have spiked tenfold and are as high as during the global financial crisis and the onset of the COVID pandemic. Perhaps counterintuitively, recessions can be good news for equities, particularly if prices have already fallen dramatically. Now that's because rather than focusing on the negative pressure on company earnings, investors instead look to the fall in bond yields and the consequent positive effect on present values, remembering that a present value of a future dollar is worth more when interest rates fall. But should we be getting too excited? Have we hit the bottom already? Even though I've recently invested additional capital in our global small cap fund, I'm not certain we've hit the bottom. I can see reasonable arguments to suggest that there could be more losses for equities. To be clear, of course, this would be a positive for anyone who considers themselves a net buyer of shares. You want to buy when shares are cheap, not when they're expensive. And remember, the lower the price goes, the higher the subsequent return. History shows the market has always recovered its losses to make new highs. The US Fed funds curve, the futures curve, has recently reduced its bet on additional aggressive rate hikes and is even forecasting an easing of interest rates next year. Who would have thought? Along with the decline in the oil price and other commodities, for example wheat, corn and copper, the reversal of rising bond rates suggests investor sentiment has switched from inflation to recession. Unfortunately, the optimism is due to the US Federal Reserve's history of backing off rate rises whenever the equity market has fallen between 15 and 20%. It's what we all call the Fed put, the idea that it will rescue investors by cutting interest rates again. Now, it is true that the US Federal Reserve eases aggressively when bear markets in equities precede recessions. However, it's also true that when the Fed has chickened out, the circumstances were very different to today. And that's the important point. Since the 1990s, and certainly after the global financial crisis, the primary problem confronting central banks and governments has been pallid organic economic growth and low inflation, and even the intermittent threat of deflation. Understandably, in those circumstances, rate cuts make sense and are justified. But prior to the 1990s, the Fed's response was different. In the 1970s, for example, persistent inflation meant Fed policy was aimed squarely at fighting inflation, with less concern for the impact on economic growth. Back then, the Fed raised rates despite already large falls in the stock market and a weakening economy. One wonders whether that could happen again. I can't be sure of whether today's US central bank will be as callous as it was decades back. However, the reality is inflation has broken out and wage growth is accelerating, with unions protesting and striking. That risks a dangerous wage price spiral. So, have we reached the bottom yet? Well, uncertainty about the Fed's stance is sure to mean more volatility. Until we get a clear read on interest rates and what the Fed's going to do, the lows could easily be retested. That's all we have time for today. Thank you for listening and watching, and I look forward to speaking to you again soon. In the meantime, please follow us on Facebook and Twitter.